So you want to learn how to trade, but you get stuck on the big question. What the heck do I actually get in a trade? You see the price going up, you think, okay, cool. Then it pulls back a little and you panic. Is it crashing? Should I wait? Should I buy now? It's confusing, right? Well, today I'm gonna show you a super simple tool that helps answer the exact question. It's called Fibonacci. Weird name, I know, but it's basically a cheat code for finding amazing entry spots. And I'm gonna break it down so easy. You'll be able to use it by the end of this video. For real. Let's get into it. First, let's talk about how the market moves. It never ever goes in a straight line. Never. It moves in a rhythm, kinda like breathing. It takes a big step forward, which can call an impulse move. Then it takes a little step back to catch its breath. We call that a pullback or a correction move. Our whole job as traders is to get into the trade right when that little pullback is ending and the next big impulse move is about to start. That's the sweet spot. That's where you make money. The question is, how do we know where that pullback is gonna stop? Oh no! That's where this thing comes in. The Fibonacci tool helps you predict where these pullbacks are likely to end. Think of it like drawing potential floors or ceilings on your chart where the price might bounce. Okay, so how do we use it? It's simple two-step process. Seriously, just 2 steps. This is the most important rule. Are we in an uptrend or a downtrend? An uptrend is easy to spot. The price is making higher highs and higher lows. It's like it's climbing a staircase. A downtrend is the opposite. It's making lower lows and lower highs. It looks like it's falling down a staircase. If the chart looks like a messy scribble going sideways, just close it. Don't trade it. We only want to trade when there's a clear direction. Got it? Good. To do that, we need to find 2 things. A swing low and a swing high. Don't let the weird names scare you. A swing low is just the bottom of a big V shape on your chart. It's the lowest point before the price swung back up. A swing high is the top of a big mountain peak on your chart. It's the highest point before the price swung back down. Okay, you with me? We know the trend and we know how to spot the start and end of a big move. Now, for the fun part, let's draw this thing. Let's say we're on an uptrend. Price is climbing that staircase. You find the last big move. So you find the most recent swing low, the bottom of the V. And the swing high, the top of the mountain peak. Now, grab your Fibonacci tool. Here's the rule. In an uptrend, you always draw from the bottom to the top. So, you click on the swing low, hold it, and drag your mouse all the way up to the swing high. Then you let go. Bam! Now your chart has these new lines on it. You'll see one labeled 0.5, another labeled 0.618. These are our golden zones. We are now just waiting for the price to pull back and touch one of those lines. See that? It came down, tapped that line like a trampoline, and then took off. That's our entry signal. It's that simple. Now what about downtrend? It's the exact opposite. You find the last big move down, so you find the most recent swing high, the mountain peak. and the swing low, the bottom of the V. The rule for a downtrend is always draw from top to bottom. So you click on the swing high, hold it and drag your mouse all the way down to that swing low. Let go. Again, you get your lines. You just wait for the price to pull back up to one of those lines. When it taps one and it starts falling again, that's our signal to sell. Okay, before we wrap up, I've got 2 final pro tips for you that will make this strategy so much better. This is really important stuff. First, you'll notice other lines on the tool, like one called 0.382. So, which level should you be watching? Well, think of it like this. When a market is moving super fast and strong, like a rocket taking off, it doesn't have time for a deep breath. The pullbacks are usually really small and shallow. And in those super strong trends, the price will often just tap that one first 0.382 line and then keep going. But in more normal and mature trend, what you'll see most of the time, the price likes to take a deeper breath. That's when it will usually pull back to our 0.5 or 0.600 levels. Those are your breathe and bother zones for most traders. So only look at that shallow 0.382 level if the price is really flying. And the second pro tip, and this is the most important one, please do not use Fibonacci all by itself. The best trades are the ones where you have a few different clues all pointing to the same spot. We call this confluence, a fancy word for things lining up. So when the price is heading toward your Fibonacci level, look for other things. Is there a trend line also pointing to the same spot? Is there a moving average there? The more reason you have to take a trade, the better. It stacks the odds in your favor. And please always know where you're gonna get out if you're wrong. Use a stop loss. That's your safety net. So that's it. That's the simple way to use Fibonacci to find incredible trade entries. Happy trading and see you in the next video.